And we like to take some of the topics, some of the people that you see in the journal, and bring them here live. And for this session, we have Harold Dupuy of Stuller. Harold has run a regular column in our magazine called Industry Snapshots, where he takes trends, he takes statistics, and he basically creates a roadmap to see where we're going and how other people can get there too and have success. Harold is currently Vice President of Strategic Analysis for Stuller in Lafayette, Louisiana. Before that, he operated a private appraisal practice in GemLab in Baton Rouge. He holds several gemological and appraisal credentials, including Fellow of the Gemological Association of Great Britain, GIA Graduate Gemologist, and Master Gemologist Appraiser from the American Society of Appraisers. With that, Harold, it's all yours.
Thank you, Rich. Hey guys, thank you for coming. In the back, can you hear? Does it sound good? Everybody good? Great. I'm going to try to cover 120 slides in 50 minutes. If you have an important question, stop me along the way, I'll answer it. Fair warning, if we get into sidebar discussion, I'll never get through the deck. But I'll be here after for Q&A. As long as you have questions, no guarantees on the answers, and I'll be here. Today I'm going to talk about COVID and the recovery and the impact it's done to the world, particularly our industry, and what I see going forward. Some economic indicators that came out of COVID. The jewelry industry is a big picture, and when you hear me say jewelry industry, I'm talking about any retail business that sells fine jewelry. Jewelry stores, next up, is about 42% of fine jewelry sales in America. So the gap between the 42 and the industry, I call the other sellers. I put all other types of verticals in that category. A little bit online, bridal, very key category in the industry. The diamond industry, a little on jewelry manufacturing, should be, we're here at a manufacturing show. And we'll look at a long-term picture, wallet share for the consumer back from the 80s to today. And some challenges and opportunities I see looking forward. So let's get started with everybody's favorite subject, right? COVID. Huge supply chain disruption. It really was a perfect storm with the lockdown and an unexpected surge that came back. Shipping containers increased costs by tenfold. It went from $2,500 to $25,000. And all the PPE materials we needed for COVID, the containers were in America and they wasn't in the right place as it came back and the surge came back. So truck driver shortage, chip shortage. Auto industry has lost 7 million units, about $210 billion of revenue because strictly due to the chip shortage. Labor shortages, right now there are 11 million jobs openings and there are 5 million people looking for full-time employment. So they got their pick, 2 jobs per person. The consumer's in real good financial shape, the lowest debt ratio since the Great Recession. But there's some headwinds we're looking at. Interest rates, 6 increases coming this year. The labor shortage. The biggest one I see is inflation. It could really hurt the industry. 22 will be slower growth than 21 in my view. How much? I had the answer to that before the Ukraine war started. Right now, it's anybody's guess. The recovery is going to vary by product lines. The full supply chain recovery won't happen until 23. And why? There's no end-to-end transparency. There's no big picture. A lot of fragmented logistical supply chains, but not one holistic. Consumer spending accounts for about 2/3 of the GDP in America. It's broken into goods and services. A 2-year picture, you can see if you're in the service industry, you suffered all through 20 and came back in 21. Very, very healthy growth. In fact, it's 4.5 times the normal growth of the last 2 decades, at least in 2021. January came out strong, but if you compare, you see the growth starting to slow down compared to 21. You'll see that trend all throughout the slides. Americans typically save 8-9%, and look what happened when the stimulus package hit. Huge, huge. They all went to savings, in the two releases of the stimulus packages, lockdown, no traveling, etc. Turn that into dollars, normally about $1.5 trillion in consumer savings accounts. You see it spiked to $6 trillion. America's doing a pretty good job. It's spent. It's gone. Got spent last year. Household debt, I mentioned, is the lowest since the Great Recession. Savings is gone, but checking accounts is healthy. Normally at $1 trillion, 3.8 trillion at the end of last year. So there's a lot of gas in the tank of the consumer for spending this year. Unemployment population, you can see when COVID hit in April of 20, down to 6 million now. This is what I've talked about, 5 million people looking for work, 11 million jobs. Unemployment rate down 3.8 in February, so we're just about back to pre-pandemic numbers. Anybody hear this term in the news, the Great Resignation? Everybody leaving their job for the greener pastures, you know? It really did happen. Almost 1 million people left full-paying jobs to go look for a better job, at least what they thought was a better job. If you dig into the data here, it's the Gen Z and the millennial generation that pulled out. And guess what they found? 70% regretted leaving. A little bit different than what they expected. Part of it I attribute to virtual interviews. You can't get a hand in the field on the culture. You can't walk the building, listen to people talk, see how they interact as a group. Their dream job, they got a reality check. And unlike the generation before, rather than sticking it out, they have no fear. 6 months, they'll quit a job and go somewhere else and try different. Used to be that was kind of a bad mark on a resume. One of the most amazing things I found in the COVID from a business standpoint was the increase of new business. This is retail, and you can see before where the numbers were running, about 400,000 a year. Over double new businesses started during the pandemic. And this is total businesses in America, same pattern, 2.9 norm, 5.4 million businesses started. A lot of folks saw opportunity created out there during the pandemic. Just a big picture, give you an idea long term, see what the change is. 2.6, 3.7% growth in new business formations in this country. It just exploded, particularly in retail. Even self-employed, unincorporated followed the same pattern. Consumer sentiment, you know, it's a metric that economists like to watch. It's going down. You can see the norm in 20. This is when COVID hit right here in April 20. The variants, Omicron and all hit there, and then inflation started to really raise its ugly head there. It's going to continue to go down because of the Ukraine situation. The good news, if you look at consumer sentiment and you look at the jewelry industry sales, over a long term, there's zero correlation. Why? There's no data to explain. My opinion is that jewelry is such an emotional purchase. It's not done with the logical side of the brain. So they kind of ignore what's going on around from the economy and go through it. It's the second lowest level in a decade. You can see it changed last year. Low confidence in government. Consumers are really concerned about inflation. That's the biggest thing that's showing up year over year. A third of them believe that they're worse off financially now. And the 75% expect interest rates, and they're right. And, you know, the majority think that we've got some bad economic times ahead. Foreign travel, I'll back this one up. How much does Americans spend on foreign travel per year? Take a guess. Americans like to travel. $180 billion per year. It's a crazy number. So you can see you're $16 billion a month, and what went almost to zero when COVID hit in April 20. It's back to a little bit above half. So people are starting to move out in the travel arena. This is TSA volume of travelers. You can see we back to normal. It was 70% below normal when the pandemic hit. A good way to get a sense on demand is to look at Google Trends and get a phrase and check it, look at it over a long period of time. Jewelry stores near me, and if you look, this is Christmas 2019, pre-pandemic. So that's your norm. Look what happened in Christmas 20. Things exploded. 21 is still above the norm of 19. So, change is inevitable, but growth is optional. There's a lot COVID created that nobody saw coming on the front side. A few economic indicators, GDP, the country, the health, you can go back to 70 and 50-year picture. That's all your recessions. You can see in 21, 5.7 increase. You got to go back to the 80s to see that kind of growth. Shortest recession in history, 2020, COVID. Stock market after 3 good years, year to date down about 10 points. Inflation, this is the monster that we're facing, right at 8% in February, and no signs of reducing right now. You got to go back 40 years to find a higher inflation rate. In the past 20 years, the norm's been around 2%. Just to give you some categories, used cars led the way, the shortage, just supply and demand, the computer chips issue. Gasoline, we all know about. The good news, if you look on the bottom of the slide, booze only went up 4%. So jewelry went about 4% last year. So it's not on the top of the chart. I had a good forecast for 22, pre-Russian invasion of Ukraine. The gold numbers were about 22 forecasts based on a lot of analysts around the world. This is the Russian stats. So right now, this is where the markets are. It depends a lot on the length of the war, where it'll end up. So let's get something more exciting, the jewelry industry. Anybody know how much jewelry was sold in America last year? Take a guess, in billions. I can't hear you, but whatever you said is wrong. Surprising number. $115 billion in last year. So there's about 20 billion in that number of watches. So it gets down to 95 billion of jewelry. Just mind-boggling numbers when you look at the increase over prior year. So question to you, how many places can a consumer buy jewelry in America? How many stores? Lots, 80,000. We know there's about 21,000 jewelry stores, so the other 60,000 is what I refer to as the other sellers. That's department stores, warehouse club, clothing stores. All other vertical is in the other sellers category. So this is the way the sales broke out, preliminary rough estimate for 21. And jewelry stores, about 30% of the doors, 42% of the volume, so a little bit stronger. Typical jewelry store over the last 5 years is doing $1.25 million, $1.4 million, $1.5 million. Last year, the national average was over $2 million per door. You just do the math, so shows you what a tremendous growth last year. If you own the business and this was your 70-year curve, you'd say, okay, I'm healthy. I really am. Long-term prosperity. That's jewelry industry sales. And in the Great Recession, 2 years, it took 2 years to shave off $10 billion in the Great Recession. And last year, it grew $38 billion in 1 year. 38 billion growth in 1 year. Highly unexpected by everyone in the biz. Here's the numbers per decade, and you can see in 20, and look at last year. What an aberration, huh? Crazy times. Going back, I went back to the late 40s. The highest single-year growth I could find occurred in 72. It's 26% year-over-year growth. So last year, double that number. Phenomenal. Jewelry is a share of total consumer spending over time. You can see it's been going down since the Great Recession. Last year, put it back up top. It equaled the late 80s and mid 90s in the heyday of the jewelry industry. So the share of wallet jewelry just exploded last year. Two-year picture for the industry, COVID down 50% in April, came roaring back, set record, and even against 19 plus 54. We came out of the gate strong for 22, up 24% for January. January is going to grow strong, I believe, in the first half, and it's going to start to slow down in the second half of the year. And if you look at jewelry compared to total retail, that's your total retail picture. And this is the jewelry picture for last year. Just incredible, no matter how you shake it out. These are the categories for last year. Jewelry was the first place tied to clothing out of 65 product categories that the Feds track. Once again, an incredible year. The booze only went up 6%. We're in good shape. January is the only month published this year. As expected, gas prices up. Another good news you can see at the bottom of the chart. Booze is going the other way, negative 2% on liquor, so we're in good shape. Jewelry stores about 15% for the first 2 months. And incidentally, let me add something right here. The Feds quit reporting jewelry stores in March of last year due to insufficient sampling. So I'm using Edge Retail Academy for my directional numbers on jewelry stores. Roughly 1,200 stores, about $3 billion annual sales. So they're pretty good samples. So it's directional, but they're not going to be precise. I've looked at Edge versus Fed's numbers for years. There's about a 4% margin of error. So you're within the ballpark. $100 million retailers. Here's the big guys, the public companies. Signet just reported. Had an incredible year with a 50% increase. Went from a negative 57 million red ink to making 903 million. Quite a turnaround in 1 year. Jewelry stores, there's about 15,000 jewelry store firms. That's a term Feds use for companies. 21,000 stores. There's a lot of concentration in the jewelry store sector. The 50 largest companies own about half of the market. You can see there's about 5,000 stores out of the 21,000 that control 45% of the volume. And they account for, 2 billion average in the four largest down to 266 million, the top 50. So you can see there are 13 billion out of the 31 in that picture. Jewelry stores, there's a lot of small mom and pops in that business. This is kind of the average. This is 17 data. Data's not out for last year. The strongest sector in the jewelry store is companies that run between 10 and 25 million a year with a handful of doors. They average $6 million per door. They're the most productive in the entire marketplace. Product sales mix doesn't change year to year. About half of the business is diamond related. Carat gold jewelry, watches runs about 12, color gemstones, and a lot of other categories. These are fairly static through the years. The same picture I showed you, the industry, this is jewelry stores going back 50 years. And you can see that big spike. They lost $5 billion in the recession, and they picked up $15 billion last year in 1 year. Year over year, similar to the industry, the biggest increase was 23% in 1980, and they doubled that number last year. January, February, based on the Edge, they're running about 15%, a little below. The industry's running about 25%, so they're losing market share. It's a trend that's been going on for a long period of time. Same picture, when I tell you the industry dropped 50, well, the jewelry store is almost 80% because a lot of these guys will close. The big box guys can stay open because they call it essential. Holiday it's been for a long period of time getting shorter and shorter in the industry. And that business is getting spread to the spring of the year. 20 is an aberration because of the closures. As you see, 21 gives you a little stronger picture. So, growth was 23 and 29% the last 2 years. You can see the dollars here, how a massive increase in 21. This is the seasonality shift. If you add up November, December, about 5.5% of the year is taken out of the fall and put it in the spring part of the year. Yeah, JCK headline, industry shrank less. Okay, well, it did. We opened about 385 new jewelry stores. You can see the last 5 years, fewer stores have been closing. It's been a healthy trend. JBT for retailers, wholesalers and manufacturers. Actually, the number of stores closed went down 18% last year, which is good. Same thing as you saw in the big picture, 2.5 times increase in the number of new stores open. So all healthy. I use this phrase all the time when I'm talking to people. They get concerned about store closings. And that's population, that's not dollars. If you go back to 20 years and look at jewelry stores, we were oversaturated, almost 30,000 jewelry stores, down to 21 now, so you got a change of 26%. Population growing up, so you got a lot more population per store. The market's really, really exploded. So sales per store, 2.5 times it was. So the pie is getting bigger with fewer players. So the shares are all really growing. You look like this is the two curves. 160% growth on revenue, 26% reduction in population. You can see jewelry stores, we still almost as many as new car dealers. So still a lot of population. My estimate that jewelry stores in a decade from now will be somewhere around 17,000. We're still going to have some cleaning out to do. If you look at inflation over a long period of time, because we're in a business where precious metal and diamond prices influence revenue, jewelry store sales growth just anchored in 92 and rolling forward. And this is inflation. This is a multiple. So you can see after every recession, the ratio drops tremendously. But after 22, it's running 58% above inflation for that period of time. So healthy growth. Producer versus consumer prices. Producers prices at the wholesale level. Price increase at the wholesale. Consumers prices at the counter. I like to track that. In the last couple of years, there's been margin squeeze at the jewelry store counter. Things changed last year with demand. For the first time in 3 years, margins went up. They outpaced the price increases they were getting from the manufacturer. So it really became good bottom lines last year in the retail sector. Online, growth per year, normally in the 12-14%. What happened in 20 during the lockdown? It just really exploded. It's back to normal now. Retail sales year over year and online sales year over year. Something really strange happened after 20 with the explosion of online sales in 21. It's the first year since they kept track of online, goes back to 20, that total retail outpaced online. It's that big surge, big resilience of people getting back out and shopping in the stores. Anybody got an idea what percentage online sales represent of total retail sales in America? Take a guess.
34.
34?
12.
12? You saw the deck. No. Running about 13%. Went up to 14. Everybody thinks it's half or more, but it's not. But globally, it's about 19. So U.S. as a country is not quite keeping up with global. Here's your dollars, and if growth continues, we'll be approaching $1 trillion of online sales in 2022. Jewelry lags a little bit. 10 billion in 20, probably somewhere around 15 billion jewelry online. The biggest category is engagement rings, where close to 1/3 is sold online. And that makes sense because of the age, millennial group, and digital natives that grew up with it. It's just normal. There's a lot of talk out there. Remember online sales first started out, it was going to kill retail. Well, both channels have become much more closely linked now. The more stores opened last year, for the first time since 2007, over 4,000 retail stores. And retail stores are serving multiple points now: pickup, returns, experimental, and digital advertising has gone up tremendously. So that's got a lot of folks back. They're different, like I said, a lot of experimental. It's sporting goods stores, even Untuckit, which is an online brand, 88 physical locations, 100 more. And they, coming from the online side, they don't look at it as different. Warby Parker, a lot of stores. So they're no longer e-com versus brick and mortar. It's kind of supporting each other. So think of this word. Just remember this word. They'll kind of paint the picture for you. Digital. Physical and digital put together. Bridal, a very important category. Pandemic had a negative effect where weddings normally 2 million a year, dropped down to about 1.3. The dotted lines are estimates, about 1.9 last year, and it's forecasted to be 2.5 million weddings in 22. So this will be an all-time record high for weddings in America. The seasonality of weddings has shifted. First, engagement ring seasonality. It's a year-round business with a big spike in December, but weddings have shifted to the fall. The June bride is no longer the number one month. The fall is. Engagement rings, normally a $6.5 billion business, fell a lot in 20, climbed back, but it's going to hit a peak of about $7 billion in retail sales. And in America, 88% of brides acquire an engagement ring. That's the highest rate in the world. 2.2 billion engagement rings forecasted to be sold this year in America. And if you break it down by the engagement ring and dollars, and look at her wedding band, his wedding band, and you'll look at a total. We're looking at a $10 billion segment of the jewelry industry in 2022. Metal engagement ring starting to shift a little bit. White gold still dominant at 45%. Yellow is picking up at a 20% share. Platinum pretty steady. Rose gold and silver. Her band fairly close, a little bit less than platinum, a little bit less than yellow, but fairly close. Big thing here been going on for probably a decade is custom business continues to grow and grow. This is the NOT data from 2021. Their survey, which is probably the best data you can find, that says that 12% of consumers walk into a jewelry store today and buy something as is directly from the case. So if you're a retailer and you're carrying the same inventory you did a decade ago, you're not getting your return on the investment. Complete custom, somebody walking in the store with a picture from Pinterest, napkin sketch something, a third of the bridal business today. So it's really a huge category. This is where the big picture is. Most of the people come into a store, see something they like, and they want to change it. Want to alter something they see, whether it's stone size, shape, metal color, whatever. So anything in custom is really the biggest part of the bridal business today. The complete custom is about $3.5 billion. It's a sizable market today. People laugh when I add divorces to the bridal category. Divorce rate is going down per 1,000, but there was 747,000 divorces last year. It's a great opportunity for restyling. What is restyling? It's custom work. It's not engagement ring, but it's custom work. So if you take your divorces and say the average person would spend $2,000, maybe $3,000, I'd put another $2 billion there. So if you look at the custom market, it's somewhere between $5 and $7 billion a day. A huge, huge market. Trends. Since 2011, the last decade, buying out of the case, 60% a decade ago, down to 12. Buying something in the case and changing about half of the business in complete custom. So the long-term trend, don't see it changing anytime soon. The composition of engagement rings has changed quite a bit. 13% of them are the non-diamond typical ring. It might be colored gemstone, it might be a colored diamond, it might be something in a natural, clear diamond. Quick changes. Last year, prices were up. Independents about a 40% market share. We talked online. Rounds are starting to slide a little bit, about 41%, down from about 47. Gold is picking up that slack there. Engagement rings, white gold is finally starting to see a little bit contraction, with yellow gold picking up the slack, platinum growing a little bit, and rose is kind of seeing its heyday. customization we talked about. Here's a big takeaway here. This is not the data, this is my interpretation. 80% of the couples bought the ring and the diamond at the same store. If you go back 2 decades, that was about 20%. So why the change to 80? I think it's custom. Once you get a customer at the store, they got a drawing and you start to engage them and they've got a hand, you own them. They're emotionally involved in that picture. So custom businesses brought more diamond business into the independent sector. GIA was important, 3/4 of it. Surprisingly, 1/3 of the grooms were interested in lab grown. Half of the grooms said the natural was important to them, and ethically sourced was important to half of the couples. Diamond business, just a polished index from IDEX, just to think of it as a big mutual fund. All sizes, shapes, colors, clarities. You can see the big fall in the recession, a lot of speculation through 11 and the peak. Well, prices have gotten on top of that 2011 peak last year. And in March, it's even higher. So it's a runaway train in price increases right now. A lot of shortages in the market. If you look just year over year, 17% up last year. And if you take that index and you go from the bottom, the pandemic, you're up 32. If you go back pre-pandemic, you're up 25. So there's a lot of price increases in the diamond market today. Wrap numbers by size, a carat, 32, 3 carats, 35. So a lot of movement there. The beer sales by sites over the last 5 years, they grew 20% last year over 19. Alrosa grew 32. Annual sales for the beers, you can see they're pretty close back to their normal $5 billion revenue. Alrosa sales for the last 5 years, that's their carats. They owned about 46% of the market in carats. In dollars, they're about 30% of the market. The imports fell tremendously in 2020. Loose diamond imports into the country. What next? Well, sanctions. Alrosa shut off. 46% by carats. What's that going to do for prices? There's some ways to get around it that's legal, but it's going to have an impact. Lab-grown diamonds, just a quick tutorial on that. Once again, if you go to Google search, the best way to figure out consumer demand, natural diamond search by consumers, you can see it's inclining, it's going up. But when you parallel it to lab-grown is growing at a much higher rate. This is only an interest level, it's not dollars. The imports of lab-grown diamonds in 20, here's 21. So last year, 1.1 billion lab-grown came into America, and this is India only, which is the dominant cutting center of the world. So people say lab-grown's increasing 15%. I don't think so. It doubled in imports, and it wouldn't be imported if it's not sellable goods. Part of the reason it's markups and your natural markups, most center stones are somewhere between the 34, 46% GP. Lab-grown, this is from Edge, just a total bucket. MBI study said that the majors are taking a much longer margin on lab-grown than the independent retailers. Market share, if you take the 48 billion last year that retailers sold, about half of it is diamond. Just do a calculation. Say give importers a 25% margin and retailers that key. You got 11% market share. You finally cracked the double digit. This year, if you give it a 50% growth, could be 16% market share, somewhere around 4 billion at retail. Very interesting. This is MBI's numbers from February 20 to 21. Percentage of retailers selling, and this is the percentage of retailers whose business is over half lab grown. In 21, almost a fifth of retailers are selling more lab grown than natural. Surprisingly, 2 industry guys that are a lot smarter than me, these are their market share numbers. I asked them for it. Edon says it's a 5% market share for the industry, not jewelry store. This number is about 4 billion. Zemeski's got it at about 6 billion. I think it's around 4.5 billion. So we're all in the same ballpark. methods to grow them, and this is not gemology. I'll go through these real fast. You guys probably know this. HPHT, closest thing to Mother Nature. These big brushes like that. CVD, a little bit more refined. Microwave and some gas, some diamond seeds. But this is what's important. Screening versus identification. If you're in the business today, you're in the lab-grown business, and you need to have some screening protection. Because that reputation that you built up over the years can be gone like that with non-disclosure. Very important. It's what I call the minimum standard. Most of the screening devices work on some properties of luminescence. We won't go into it. And the growth method. On the other hand, identification requires advanced spectroscopy and a lot of advanced knowledge in understanding optical centers and defects. It's a lot of physics involved there. So stay on the left side and do the best you can with it. A lot of people don't understand lab-grown diamonds are diamonds. These guys have been around from the 90s. They don't work. They separate simulates from diamonds, not lab-grown from natural diamond. Identification, these are some of the spectrometers that you need. It really is science. It's not the jewelry business. They're expensive, and you got to have a lot of knowledge. They're not practical for the retailer. Some of them are not practical for the manufacturer. Back at Stuller, we own all of these. That's over 100 grand just right there. There's a lot more than that. Screening, just the yes/no separation. Just want to protect yourself. It depends on the technology and the instrument. Some of them will look for lab grown. Some, like the GIID 100, will confirm natural. So if it doesn't confirm natural, you don't want to. You got to send it out. You don't know. It's 100% accurate, and the instrument like that is really good. People always want to know what instrument can identify all lab-grown diamonds, and simple to operate, inexpensive, all sizes and shapes, all colors, fast results, and can do mounted goods. There's one instrument out there. It's called none. Can be done. It really can. The SURE project was done by Natural Diamond Council. They test the testers, all the screening instruments. To date, they've tested 33 screeners. It's the best third-party testing. Think of it kind of like UL laboratory approved, but don't get too hung up if the instrument is a SURE tested. Why? Because that seal of approval means it went through the testing. If I tell Daryl I went to Harvard, he's got an impression. Gives a little bit more, he finds out, then he knows the real story. Well, you got to look at the results in the test, not just a SURE tested seal. I co-authored an article. It's 14 pages on the SURE project a couple of years ago. Anybody interested, give me an email address, I'll send it to you. We took 260 pages of laboratory and condensed it into 14 pages and give you an answer on these instruments. So, which instrument to buy? It depends on how you're going to use it. Lucid mounted, single volume, shape, size, color, manual or automated. Do you need it to tell simulants? Skill set, and do you want the machine to tell you on a readout, or are you interpreting something by the color of fluorescence or phosphorescence? Ask a lot of questions, and these are the 4 metrics in their SURE program: false positive, false negative, etc. The size, just typical things when you're buying equipment. Describe its best use. The most important question to ask a lab-grown screening equipment manufacturer: describe its limitations. What can it do? And if you can say it does everything, do a 180 and walk. None of them can do everything. Spreadsheet, just to show you, at the time I think there was 31. I put in there so the results: false positive, false negative, the accuracy, and referral. So just adding up the false positive, false negative, and scoring it in the blue column, kind of like golf. The low number wins. So you see at the bottom there, they're about 95% accurate if you take the 33 that's been through the testing process. And you have to look at the score on natural, and you have to look at the score on lab grown two different scores. So in just a summary of their tests, false positive 5.9, false negative 3, so about 95% accurate. Lab grown, similar. Let me back up. See those two yellow arrows? That means the limitation on testing was 1 millimeter. Anybody sells a piece of jewelry below 1 millimeter with a diamond? You better believe it. So you're blind below 1 millimeter unless you have some very sophisticated equipment. But 90% accuracy is what you're dealing with. Talked to a lot of retailers on this subject, so we did a model. I did a model retail store. You just got to look at your risk, high, medium, and low. Assess your risk. On the backside, if you're buying from trading networks out there, you don't know who the guy is. It's a high risk. You got to be screening heavy. Maybe a new vendor is a high risk. Ask your existing vendors, what are you doing on screening? There's more. You can fill in the blanks there, but on the front side, the biggest risk is buying over the counter. Trade-ins, repairs, you got to check all that. Appraisals, even customer returns could be a low risk today. We began at Stuller. We began in the business, lab-grown selling business in December 2016. We started selling for 7 years. Because of gemological background, I got involved in acquiring all the spectrometers and all. But today, inside the facility, we use 15 unique instruments. Those 15, we have a total of 44. So some of them, we got a dozen of this one, 6 of this one, scattered throughout 8 screening stations in the building. We got over 40 full-time associates involved in screening. Why am I telling you this? That's a lot of cost burden. So you've got to look at it as a business in whole. It's a necessary evil to protect your reputation, but you've got to do it. Gia Inscription, look, not in America, but overseas right now, there's more fraudulent lab-grown diamonds being cut to match a GIA report. GIA is going to launch a new instrument at JCK. It's a combination of OCR and AI technology to validate that an inscription is theirs, to authenticate that diamond and that report matches. So don't just look at the inscription. I've already said these. Witsio, when in doubt, send it out. If you don't know, the machine doesn't know, send it to a good lab like GCal. He knows. He's got all this equipment before he sells it. It only takes one undisclosed, and some bad publicity to ruin the reputation you built your life on. So even if you're not in the business of selling lab-grown diamonds, I hate to tell you, you're in the business of lab-grown diamonds because they're in the market. Manufacturing, what percentage of jewelry sold in America is made in America? 5. AJ's an optimist. Murphy's Law. You ever heard of O'Toole's Law? He said Mr. Murphy was an optimist. It's about 20%. It varies, 18, 22, somewhere in there. I think it was a lot higher in 21 because of imports. In America, it's about 2,000 manufacturers, give or take. Like the jewelry stores, there's a lot of concentration. The 50 largest companies control about 3/4 of the market. So 2.5% of the population, 3/4 of the market. The 4 largest average about 550 million, it's 820, and 50 largest around 100 million annual revenue. So you can see the industry right now is somewhere close to 8 billion U.S. jewelry manufacturing. You can see a decline over the years. The striped ones on 20 and 21 are forecasts from Ibis World, the global research firm. I think they're wrong. That's why I striped them. I don't think it declined. I think it went up because you got about a $20 billion shortfall in imports, and you got this huge retail growth. It took care of some of the existing mid-screen inventory, but not all of it. So I think these numbers are going to come up closer to about 8 billion. There's your big shortfall right there, about 15 billion. Against 19, it came back strong. So you can see 43. If you break the imports down, colored gemstones about 3.5 billion. Gem diamonds, normally in the 24 billion, really, got cut way down to 20, still didn't make it back in 21. What boomed is finished jewelry. 20 billion came in last year, whereas normally in the 12 to 14 billion dollar range. Disc jeweler census, should have asked you a question. How many disc jewelers in America? I gave you the answer, 19,000. Easy to hire one, right? Not a chance. About 40% of them work at jewelry stores, about 27% in the manufacturing sector, wholesale sector, and then the design services, pawn, and other. One of the issues that I think disc jewelers overall are very, very underpaid in America. You see the median price point coming in at about $20 an hour. That's median, so half below, half above. Not really a strong wage in today's times. Even at the 90 percentile, you're at 77,000. Even more disturbing, look where the highest paid jewelers work. They're in the pawn sector. Doesn't speak good for the industry. Challenges and opportunities. Good on time. I'll let you soak this in for a while, just to recap what happened in 21. This is a once in a lifetime tsunami of sales growth. We'll never see this again in our lifetime. Total retail, 18%, industry in the 50s, jewelry stores in 46. That's your average for the last 3 decades. 34% is the norm. That's the norm when you blow to 51. Crazy year. This is the biggest challenge I see with the independents continuing to lose in market share. You go back 50 years, they own 3/4 of the market. They got about 42% share today. If you just take the growth in the last 2 decades, you've got 40% going to independents and 60% going. $83 billion of growth, and independents only took 40% of it. This is a slide I used for an internal presentation at our annual kickoff meeting. And by decade, you can see the independent in the industry, and that's your growth from 70 to 20, so 50 years, from 4 billion to 76. Based on that growth rate, this is what I said, like year 2030, the industry would be. This is what happened last year. That growth rate would have been 2040. So essentially, we put somewhere between 15 and 20 years of growth packed into 1 year. Are we going to see it again? Not in our lifetime. The jewelry industry, for a luxury industry, is the most resilient on the planet. You go look at other luxury brands, take clothing out of it because they had a good year. You won't find any sector close to jewelry. And I'm going to show you a slide. It's hard to believe, but it's federal data. It's the jewelry industry growth, and why I want to show it to you. Anybody know what happened between 1939 and 1945? It was a world war, World War II. In today's dollars, the jewelry industry went from 8 billion to 22 billion while a world war was going on. Is it resilient? It's the most resilient business on the planet. Some takeaways, I'll leave a few minutes for questions, easy questions. Unexpected growth. Why? Well, vaccination went up, stock market's booming, unemployment went down. Experience-based purchases were very, very limited. Huge stimulus. You saw those savings accounts. They fell out the sky. Pent-up demand, plus money in the bank. Consumers are still ready to spend. Savings are down, the checking accounts are really high. Digital, we talked about. The diamond industry got rid of a lot of glut in the midstream. They've been accumulating. Inventory went down, bank loans went down, so higher liquidity. Incredible new business formations, both in retail and total business. This year, I think I said it earlier, slower growth in 22, but well above historical norm. And I put this deck together pre-Russian invasion of Ukraine, so you know nobody knows the length of that it's going to take, and it'll have an effect. But I think we saw for the first 2 months the independents at plus 15, the industry in January plus 24. So they're going to have a good year. Indicators are positive. The biggest one is inflation. Interest rate hikes, you have 7 of them, quarter each. So, okay, you had 0, you're 2 1/4. BFD, right? It's still below historical norm in interest rates. Supply chain charges won't completely heal until 23, some beginning of 24. There's going to be some corrections in it, but jewelry continues a strong first half, so the industry is very healthy. And the caveat, the deck was prepared pre-Russian invasion. So the industry is a long-term growth industry, and it has a bright future. I hope the last 51 minutes has shed a little light on the industry. You might have learned 1 or 2 things, and I'm ready for some easy questions. Thank you. Been a good audience. Thank you. Any questions related? Did I thoroughly confuse you? Did it give you some context? What's the question? Ani? Oh, Ani has a question? Mike. The mic. Yep. So everybody can hear your question.
Thank you very much. It was a wonderful presentation. Mine's very quick. In the beginning, you said that jewelry stores sold 42% of jewelry. And then later on, I saw a slide that said people were Googling jewelry stores by me, and there was a peak. So if more than 42% are not jewelry stores, can you explain why the peak for jewelry stores near me is a peak?
Yeah, the Google trends with people looking to buy in that month, that period. The 42% is a share over a year. Take the pie over years. It's a 42% share, and the Google is more to that particular time.
Understood. Thank you. Now I get it. Thank you.
Sure. Yeah. Good question, because I have the answer. Any other ones? Okay, take the mic, sir.
Okay, I'll try.
Here comes a good question. He's not a plant.
In the first part of your slides, you had indicated that there was a tremendous amount of people that were not traveling internationally. Is there any way to tell how much, generally people that travel international spend a lot of money? Any way to indicate how much of that might have come back to the U.S. and spent on jewelry?
Not in the Fed's data. I mean, you can make assumption that they're spending $16 billion a year. And COVID got it down to $1 billion, and that's per month. I mean, $108 billion there, 16 a month. So that's 15 unspent, and it starts to climb back. That's an accumulation close to 200 billion. I would say the majority of it, because you see these savings accounts, you put savings and checkings together, you can back into the math and the number. But I would say a lot of it got spent. I don't have the exact number. Somebody else had a question? Don, you want to? Mike, here comes the first hard one.
Okay, Harold, that was a great presentation as always. And I didn't bring any tomatoes.
Good.
I left them. But a personal question, your personal opinion. Do you feel, and you guys sell a lot of diamonds, do you feel that a will ever be willing to buy knowingly Russian diamonds? You know, Albrosa spent a lot of money to be able to embed identification, not only in the rough, but it also transfers into the polish. I think that's out the window now. Whatever number of millions of dollars they spent is probably wasted. You guys sell a lot of diamonds. Do you feel that even though there's an embargo, there's sanctions, you feel that Americans will ever buy El Rosa diamonds, Russian diamonds?
Before the war, I don't have any feedback from customers requesting Russian diamonds or not saying I don't want a Russian diamond. Americans have short memories. And of course, as you know, once it's polished and cut, if the retailer doesn't know where it comes from, he can't disclose. There's going to be a hangover from the invasion for a while. Any responsible company, ourselves included, shut off any Russian diamonds that we acquired. Puts more pressure on the supply side. But you have no choice, to do it right. It's hard, Don. I think the hangover is going to be a while. I don't know how long it's going to be, because I think the American consumer shopping is such a sport, and the memories tend to fade. Any other questions? No? You're welcome. You guys have been a great audience. Thank you very much.